Your focus is on companies with a succession issue or challenge, let's say, purely 100%. Or would you also look at businesses that are maybe a bit younger, maybe more like technology company, a SaaS business, which may have like very recurring revenue, but started maybe like 10 years ago, maybe the founders are bored of it, etc. Would you look at those businesses, or you end up only speaking to people who wants out because they made their money, they are too old, and they just want to solve their succession challenge?
We would look at those businesses as well, as long as the minimum threshold of EBITDA is reached. Maybe in the case of a SaaS business, the business owners are fairly young and a lot of money has been invested into growth.
Mm.
It could still be interesting to us if we feel like it is an attractive way to enter that business and that we see scalability. But we need to be very careful about how much money needs to be actually invested to scale the business, because
Mhm.
that's one of the other criteria, which is that we look at EBITDA margins that are ideally not below 15%, just
Mhm.
because, and that goes back to the explanation from the revenue point. When we enter the business, there needs to be some leeway to make errors, and we need to have enough cash flow to actually reinvest and grow the business. And essentially, if that's not the case, it makes it very tricky. And the other problem with typical SaaS businesses nowadays, the valuation within those markets is still fairly high. It has gone down a bit, but it's still fairly high. And the idea behind the search fund model as well, to some extent, if you look at value creation and what drives returns, one of the easiest component is to actually achieve a multiple arbitrage. So you buy at a fairly cheap entry multiple, you grow the business, and then you sell it at a higher exit multiple. And
Mhm.
that's part of the DNA of the search fund as well, which might be trickier to find within the sort of more traditional software SaaS market.